the legal tax loopholes that everyone is talking about and why they don't work for most investors. Now, if real estate tax loopholes actually work the way the internet makes them sound, then most investors wouldn't still be shocked by their tax bill. I see this all the time. So, people who buy property, they hear words like cost segregation, bonus depreciation, short-term rental loophole. And yeah, they expect their taxes to drop. But then filing season comes around and they're still surprised by how much they owe. This is not because they did something wrong, but it's because they didn't understand how the rules actually work. So let me be clear about what this video is and what it isn't. I'm not going to give you a checklist of tricks. And I'm not here to promise you that buying real estate automatically lowers your taxes. What I want to do instead is explain why some of these strategies work, why they often don't, and what actually determines whether your real estate will offset your income tax in your situation. Before we get into that, let me quickly introduce myself so that you understand where this perspective is coming from. My name is Lisa Marie Odeja, and I'm a CPA and an enrolled agent, and I specialize in advanced tax strategies for real estate investors. Now, a lot of the same concepts also apply to established business owners. However, real estate is my niche. Also, previously, I spent time as a federal government auditor, and that experience trained me how to think like a reviewer. Not just how a tax return is filed, but how positions are evaluated, documented, and looked at in the event it's ever questioned. So on this channel, I break down how tax rules actually work, and not in the way that it's usually explained online, so that you can make better decisions for yourself before the tax filing season. When people talk about real estate tax loopholes, I find that they're usually talking about a few specific strategies, such as cost segregation, bonus depreciation, and the short-term rental rules, which supposedly allow for losses to offset your W-2 income. On paper, these strategies sound powerful, and in certain situations, they can be. However, the mistake that I see being made is people assume that these strategies work automatically just because you own real estate. Here's the part that most blogs leave out, and that is tax results aren't based on the property alone. They're based on the taxpayer. Listen, you can have two people purchase the identical property, use the same accountant, and even apply the same tax strategies, and end up with entirely different tax outcomes. Now, you might be saying, why? And it's because the IRS looks at things such as income type, activity level, timing, and entity structure, not just the asset alone. Let's talk about short-term rentals, because this is one of the most misunderstood areas that I see. Yes, there are situations where your losses from your short-term rentals can offset your non-passive income, such as your W-2 wages. However, it doesn't mean that every Airbnb owner qualifies. So, there are rules. These rules are such things as how much time do you personally spend in that activity? How is the property being operated? What services are being offered? And how is that participation being documented? So, as you can see, owning the property alone just isn't enough. Let's talk about property managers. Hiring property managers doesn't automatically disqualify you, but it also doesn't automatically qualify you. And most investors don't realize whether they qualify until the end of the year when it's too late to change anything. Cost segregation is another area where expectations don't always match reality. Depreciation doesn't eliminate taxes, it shifts them. In some cases, it creates losses that can't be currently used. And in other cases, it decreases taxes now, but increases them later. So, if depreciation isn't correctly planned, it can create surprises when that property is later sold. So, using this strategy isn't usually the problem, but using it without understanding how it fits into the bigger picture is. The biggest mistake that I see isn't choosing the wrong tax strategy, but it's waiting until the tax return is being prepared to ask whether tax strategy actually works. By the time your tax return is being prepared, most decisions are already locked in. The tax software can calculate the result, but it can't change the outcome. And this is the difference between tax filing and tax planning. So when I hear people talk about real estate tax loopholes, this is what I always say. They're not loopholes. They're outcomes of very specific rules, and they only work when everything lines up correctly. And when they don't, people are left wondering why they did everything right and they still owe taxes. This is why tax planning is done outside of the tax return and not inside the software. And real estate can absolutely be a most powerful tax tool, but only when it's designed for the person and not just the property. If any of this sounds familiar to you, here's what I want you to do next. My calendar link is below this video. This is where we can discuss your particular situation to see whether strategic tax planning makes sense for you. Also, if you want to see more videos like this, subscribe to the channel. I post regularly about tax planning for real estate investors. Thank you for watching, and I'll see you in the next video.